Hello, everyone, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on global financial markets for this week and beyond. Today is Wednesday, June 22nd. I'm Mike Burnick, and joining me today are David Dukevich, Mandy Bry, and Larry Edelson. All right, let's go ahead and get started. So I guess the biggest event for today or tomorrow, obviously, is the Brexit vote coming up tomorrow. It's kind of a should I stay or should I go thing. Regardless really of the outcome, whether it's for leave or for remain, though, I think we're going to see some pretty volatile market moves in maybe perhaps both directions, no matter the outcome. Larry Edelson, you just wrote about this in your Money and Markets column today, so why don't you give us a kind of a summary of your views on the topic?
It's clear to me that Britain should leave. I mean, they should take back their sovereignty and not subject themselves to the European Union's dictates. That's my opinion. However, the vote will probably stay as a remain vote. I have a feeling the election is going to be rigged one way or another, and it's probably going to be a remain vote. I don't think the leaders are going to let the populace vote to exit. I could be wrong on that. But either way, whether they leave tomorrow or, they leave another referendum down the year, years from now, the end result's going to be the same. The European Union is breaking apart. It's an artificial political union to begin with. It's a harebrained scheme to unite the continent, to avoid previous wars, to try and emulate the United States without a federal national bond market. They've done everything half-assed backwards, and it's disintegrating. And the only ones it's obvious to is everybody but the European leaders. So, Europe's going down the tubes. It's just a question of time. I expect we'll see, as you just said, Mike, quite a bit of volatility tomorrow. Most of the brokerage firms, I got a notice from IB yesterday, Interactive Brokers, are tripling margins on currencies and on precious metals starting later today, which may cause some liquidation of positions that are too heavy. Risk-off type of maneuvering later today. And but, trend-wise, nothing's changed in these markets. The Dow is still in a long-term bull market. It won't break out until we get a Dow closing above 18.5. Gold is still in a trading range within the confines of a long-term bull market, but one that must pull back nicely down to below 1,200 before it can really get the energy to take off. Mining shares are overdone on their first leg up. Same with gold and silver. They need to pull back. And, we may see the trigger being a Brexit vote to stay in tomorrow. If we get a closing below 1268 August futures today, that's a sell signal on my system. And that would for gold, and that would indicate for me that we're going to probably have a stay in the union vote tomorrow, and probably a sell-off in gold and a rally in the dollar against the euro. But who knows? I'm just reading the tea leaves from my economic models. Other commodities, oil expecting a pullback there with another run to the 55 to 56 level. Likely over the next month. Grain markets starting to look good. Currency markets, I still like the dollar. It doesn't look good. It's been in a long, protracted, basically sideways correction, but I still like it very much long term.
Okay.
That's all I got.
All right, appreciate those insights. We'll certainly see a lot of, I think, turbulence in the market one way or the other, both maybe later today and certainly tomorrow and Friday. Let's see, Mandy Bry, I saw an interesting stat today that second quarter S&P 500 earnings are estimated to decline about 5%, and if so, that'll be the five straight quarters of year-over-year earnings declines for the S&P. That hasn't happened since the Great Recession in 2008, early 2009. Then we should return to earnings growth according to the Wall Street forecast in the third quarter. What's your take on that?
Hey, good morning, Mike, and good morning, everybody. The multiple quarters of contraction has been it's pretty painful for corporations, but the direction of the market has led you to believe that we're not in a earnings recession, and particularly some of it has been blamed for currency and commodity strength and weakness, respectively. However, since some of that has abated, oil has rallied from 26 to sub 50 now, and the dollar is off of its highs. Everything starts to look rosy again in terms of the picture in terms of not the next quarter, but 2 quarters down the road, 3 quarters down the road. So the market is a forward-looking mechanism that's trying to price in today an improvement further down the road. However, as you know, when the market goes in a single direction to the upside, while earnings go in the opposite direction, you're getting more and more pricier and more vulnerable. And that's where we kind of are. We're in the top end of the range in the S&P 500. We're also in the higher end in terms of valuations. We're at 19.5 times trailing estimates because of those declines in earnings. So we may, from my perspective, I think we've gotten ahead of ourselves a little bit too far too fast. And that's mainly a function of the U.S. In the relative spectrum being the best house in town, and also the printing and the reflation trade that's going on all around the world with the search for yield coming to the U.S. Now the thing is that when you do see that money come in, you're not seeing the same sectors that you believe would kind of hold up the rest of the market. You're seeing utilities, telecoms, and stables types of names that have higher yields, more stable dividends, and more mature companies rather than growthier, rosier outlook companies. And that also makes usually you see a multiple in excess of the historical averages for companies that have more growth tied to them, because you're willing to pay up for that growth. But when you're paying up for utilities, telecoms, and names like that, when you're not getting any growth in terms of top line, and your best bet is just kind of waiting for that dividend. That proves to be a little bit more worrisome in terms of the breadth of the market. So from an earnings perspective, we are, probably a little bit ahead of ourselves, and leaves us vulnerable. So when we do get, whatever the referendum announcement is right now, we're split down the middle. Expect to see wild moves either to the up or even to the downside, and I would say that the risk is for more volatility is going to be to the downside. If you do get an exit, the focus is going to be on what the impacts are going to be on the other European countries that currently have, according to Pew Research, unfavorable views of the EU as a whole, and then we're talking about Hungary, Poland, and Italy, the big guy in the whole mix of things. So that's going to be interesting to watch. I don't know if you know, but I was born in England, and I spent the first 11 years of my life there, and we moved to New York when I was 11 years old. But we have a lot of family. The connection between England and India from colonial times is pretty strong. So a lot of Indians migrated over to England, and I still have a lot of friends and family that still live there. And the consensus there is to stay. I know that the vote is split down the middle, and I know this is a very, very limited, probably a very biased sample set. But from what I'm hearing, most of the votes are going to be going to stay in the EU for what it's worth. I expect to see volatility on Friday, and I don't know which way it's going to go, but I don't want to bet on it. We've been hedged in our portfolio. We've been, all the editors actually have been saying to be cautious. of this rally for these types of events. Could be, prove to be the black swan type of catalyst that can ultimately head us, to a breakout in one direction or the other. And I'm going to be prepared with a sharp miss to the downside and also for the upside. If we do get a breakout, I'll be more cautious to the upside adding new names. Because if we do get a breakout, it could potentially be something that will be faded. And unless we get an improvement on that earnings picture, and obviously what's going on with the U.S. in terms of the election cycle, some clarity there would be helpful. But I'm going to stay cautious.
Yeah, definitely cautious, and there's the watchwords. So the inside word, though, is for the Remain vote, according to friends and family in merry old England anyway, right?
Yeah, that's a very limited sample set, so I wouldn't go by that. But yeah, that's what I'm hearing.
Well, we'll see if your friends and family carry the day. Thanks, Vinny. Appreciate it. Let's see, David Dukevich, why don't you give us your take on the various markets? Where do you see the most volatility, whether we get a Remain vote or a Leave vote?
Hey, Mike. Hey, everyone. Well, I think that's exactly right. Volatility probably will be the name of the game here. The gold market certainly, I think, could have a pretty strong move. And in fact, it potentially could go down temporarily no matter if it's in or out. And with that meaning, if they do decide to stay, I think gold could head down at least maybe 5% relatively quickly. But the other catalyst, if we do see them leave and we see the markets drop significantly, you could see gold position to get liquidated temporarily to cover some margin calls and things like that. So you could actually see it swing down almost no matter what the vote is. But we'll have to wait and see, because the initial reasoning, if they do decide to leave, you could just see that safe haven bid it up really quickly and jump. But I do think you could see a pretty strong move in gold coming on, overnight on Thursday into Friday. Mm-hmm. The equity markets themselves could as well have significant moves. I think the upside's probably going to be limited if they do remain. Maybe we get a surge to try to break to those new highs. The S&P is sitting at about 2088 right now. It really hasn't gotten through that 2116 to 2135 range, but I do think that this could be the catalyst that kind of pushes to at least touch new highs again. If we can get through that significantly, maybe it could make a run a few percent higher than that. But the real risk is to the downside. And, we could see a huge move down if we really do get that fear into the markets, where we could get maybe an 8 to 10% drop in the equity markets if the vote is to exit. Oil market right now, we had some positive API inventory numbers overnight, or last night, I mean, and, so now that oil, as it pulled back, it got to about that $47, $48 range of support. It's bumped back up over $50. We could see that pull back a little bit, depending on, what the vote is. But right now, really, it's just a wait-and-see game. I wouldn't want to be a person trying to predict what's going to happen here, so I think hedging would be your best call if you're long equities right now. You might want to buy a hedge. It could be buy calls on volatility or a futures position on the VIX just to protect yourself in case we do get a major swing down. But I do think that's where you really want to be right now. Or if you do have gains, maybe pull off a few positions ahead of the vote just to protect yourself a little bit.
All right. Mike Larson, unfortunately, he's traveling and didn't make the call today. But what's your take on bonds? We see the 30-year U.S. Treasury is down under 2.5% yield now, very close to the lows it made early last year. Do bonds have any business being way down here? Or is this just, do you think, safe haven money flows just in case there's some sort of a radical outcome?
I do think it's a safe haven bid at this point right now. And, not to mention the U.S. Bonds still are one of the higher yielding safe haven bets you can have right now. So I do think also if we do get that vote to remain, you could see bond prices go down and yields go a little bit higher as well.
All right. Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you, one and all, and be sure to tune in again next week. Until then, I'm Mike Burnick for Money and Markets. Good investing.